This is video 2 of Matilda Limited combining debentures of IFRS 9 with IAS 8. We are having a look at the required. The authors of Matilda Limited's financial statements for the year ended 30 September 2015 did not agree with the above mentioned accounting treatment of the debentures. They suggested that Matilda Limited should include a note in the annual financial statements for the year ended 30 September 2015 in accordance with IAS 8, Accounting Policies, Changing in Accounting Estimates and Errors. You are required to prepare this note to be disclosed in the annual financial statements of Matilda Limited for the year ended 30 September 2015. Note: you may assume that the accounting records of the 2014 accounting period can be opened for purposes of processing correcting journal entries. Round all calculated amounts to the nearest R1, all percentage to 2 decimal places, and ignore all taxation implications. So when they gave you the journal entries, they just said this is what Matilda Limited did. Nowhere did they say it is wrong. They didn't point that out. They just said this is what was done. The required tells you that somewhere there is a problem. The auditors do not agree with the accounting treatment. So you need to figure out what should have been done. They gave you what was done. You need to figure out what should have been done so that you can see where the differences are, so that you can write correcting journal entries for those differences to fix the error. And then you would need to include a note in the financial statements of the current year, 30 September 2015, where you show how did you correct the error, which line items in the financial statements were affected when you went retrospective, when you went back as far as you could and fixed the error as if it had never taken place. Now they ask you for the note. You can do the journal entries as a calculation, the correcting journal entries, to help you to get to the note. And for that reason, they tell you, you may assume that the accounting records of 2014 can be opened for purposes of processing the correcting journal entries. The journal entries is not what was required. You write them as a calculation to help you to get to the note for the year ended 30 September 2015 in terms of IAS 8. So we need to go back to these journal entries of what was done and have a look what is wrong. So if we look at journal number 1, debit bank, credit debenture liability at fair value. You need to know your rules of IFRS 9. Is that what the first journal looks like? Yes, it is. What should the amount be? It should be fair value. Is this amount fair value? Yes, it is. They gave us the fair value. So there's no error with journal number 1. What about the second journal? Debit transaction costs, credit bank. If you know your IFRS 9 rules, you will know that if you are in the category at amortized cost, transaction costs, when they are incurred, do not go through profit or loss. They are not an expense. The credit entry is right, bank. And bank is usually right because we do monthly bank recons. We would very quickly pick up a mistake. So usually in an IAS 8 error question, bank is not the problem. The transaction costs in this case are the problem. It should not have been an expense. Where should we have taken the transaction cost? What should have been done? We should have said debit, debenture liability, credit bank. The bank is right, credit bank. We paid the transaction costs. It's the debit entry that is wrong. Is that the only mistake? Well, yes, but it does pull through. Why do I say that? Well, if you look at the first interest journal, how do we calculate the finance cost, the interest expense? We take the balance on the debenture T account times the effective interest rate. But that balance is now wrong. It can't just be the fair value. The fair value needs to be reduced because it's a liability with the transaction cost. You don't need to memorize that. You don't need to know for a liability, make the initial amount less. Look at the journals. The debit should not be transaction cost through profit or loss. It should be the debenture liability. If you debit a liability, it will reduce the liability balance. You don't need to memorize that. Just look at your journal. So your balance is not right. What else do you know you should do if there is transaction costs on initial recognition? You need to go and calculate a new effective interest rate. If you change the PV but all future cash flows stay the same, the interest rate needs to be different. So it's a very small mistake. You should have taken the transaction cost against the debenture liability, but it pulls through to everything because every single finance cost you calculate is balance times effective interest rate. The balance is wrong and the effective interest rate is wrong because it should have changed due to the transaction costs.